You likely feel it every time you tap your card at the grocery store or open a utility bill. A lingering anxiety suggests that things are entirely too expensive, and that despite working hard, you are somehow losing ground. Look at this data tracking the broader United States economy. Gross domestic product is growing, and unemployment remains historically low. Yet consumer sentiment has plummeted. Nearly 60% of the public believes the country is already in an active recession. Economists call this disconnect the Vibecession. It describes a state where macroeconomic indicators show stability and growth, but the public experiences the psychological weight of a downturn. These bad vibes are a rational response to an environment where the official metrics we use to evaluate the economy have detached from the actual cost of human affordability. This step chart maps the price level of basic goods since 2019. Falling inflation means prices are just rising slower. Overlaying real wage growth as a flat yellow line reveals the squeeze. The gap between earnings and this elevated price floor is where financial exhaustion lives. Behavioral economics explains this pain through loss aversion, the principle that the pain of losing something we had is far more intense than gaining something new. This creates a state of nostalgiaflation. We emotionally anchor our expectations to the purchasing power we held in 2019. Every trip to the grocery store becomes a daily reminder of a standard of living that has been actively taken away. When we are forced to downgrade our lives despite working the same hours, the brain processes that regression as a persistent loss. It creates a chronic state of financial grief that national data simply cannot quantify. This pressure is unavoidable because it hits fixed costs that families cannot budget away, like rent, childcare, and energy. Hidden shocks also exist in the insurance sector. Extreme weather events forced massive risk adjustments, causing home insurance premiums to climb 46% nationwide since 2021. If real wages are essentially flat and the cost of necessities is surging, how is the average household surviving that gap? This chart shows the answer. American families have turned to a historic reliance on high-interest leverage, sending credit card debt past $1.25 trillion. At a 21% average interest rate, this drains future income to pay for past necessities. Signs of strain are appearing in the subprime markets. Auto loan delinquency rates have reached levels not seen since the 1990s, acting as a warning that household balance sheets are beginning to break. The middle class isn't racking up debt to finance a luxury lifestyle. They are leveraging their futures at predatory interest rates to finance their basic survival. This struggle is taking place within a K-shaped economy. While the working class sinks under the weight of debt, corporate profits and high-end assets are moving in the opposite direction. Federal data shows the top 1% of households now holds nearly 31% of the nation's wealth, the highest share on record. Younger generations experience this disparity through a hyper-curated digital lens. Their social media feeds broadcast a world of luxury vacations and high-end shopping halls that feel increasingly alien to their own reality. This environment fuels money dysmorphia, a psychological condition where people feel chronically inadequate and financially ruined, regardless of their actual income stability. This feeling of injustice is backed by data. Corporate profits drove over 50% of inflation recently, compared to just 11% historically. When price hikes outpace production costs to pad margins, the public begins to view the entire system as a game they cannot win. For decades, middle-class stability was built on homeownership, raising a family, and retiring. But for many in the younger workforce, the math to reach those milestones no longer adds up. When the traditional paths to wealth appear blocked, consumers pivot toward a behavioral phenomenon known as doom spending. The logic is a form of cognitive mental accounting. If saving for an impossible down payment feels futile, people redirect those limited funds toward immediate gratification, experiences, travel, and small treats that offer a sense of control in an anxious world. This spending artificially props up national retail figures, giving economists a signal of consumer strength, even as individual emergency funds drop to zero. The widespread feeling of poverty stems from a structural shift in the cost of living. Households are navigating a trend break that budgeting cannot resolve. The personal recession will persist as long as economic health is measured by stock market highs and aggregate growth, rather than the financial resilience and affordability of the average home.